In 2021, a 20-year-old college student in Nebraska put his entire $25,000 student loan into a single call option on Tesla. In 48 hours, he made $400,000. He posted the screenshot on Reddit. The internet called him a genius. 6 months later, he put that $400,000 into another trade. He lost everything, every single dollar. Was he investing or was he gambling? And do you know the difference? Because if you don't, you're probably gambling too. This is Chapter 1 of The Intelligent Investor by Benjamin Graham, Investment versus Speculation. Benjamin Graham, the most important financial mind of the 20th century, asked the most fundamental question in all of finance. What is the difference between investing and speculating? Graham says, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Let's break down all three conditions, and all three must be met. First, thorough analysis. Have you actually studied what you're buying? Do you truly understand the business? Have you looked at the numbers? Or have you just heard a tip from a friend or seen a TikTok video? Second, safety of principal. Is your original money reasonably protected? Are you betting it all on a coin flip? Is there a margin of safety, a cushion between what you paid and what the thing is actually worth? Third, adequate return. Are you chasing maximum return? Are you expecting 10x overnight? Or are you aiming for a reasonable return that compensates you for your time and risk? If even one of those three conditions is missing, then you're not investing, you're speculating. You might call it investing. Your brokerage app might call it investing, but Graham would look you in the eye and say, no. That's speculation. And here's the important part. Graham doesn't say speculation is always evil. He says it's inevitable. People will always speculate. But the disaster happens when you think you're investing while you're actually speculating. When you take gambling-level risks with money you believe is safely invested, that is a confusion between investing and speculating, which has destroyed more wealth than any market crash in history. Let's look at our first story, Warren Buffett's story. Warren Buffett studied under Graham at Columbia Business School in the 1950s, and he took this lesson, investment versus speculation, and made it the foundation of his entire career. When Buffett buys a company, he doesn't look at stock charts. He doesn't care about momentum. He only asks three questions. First, do I understand this business? Can I explain how it makes money in one sentence? Second, does this business have a durable competitive advantage? Will it still be relevant in 20 years? Third, is the price reasonable? Am I paying less than what this business is actually worth? He invests when answer to all three is yes. If any answer is no, then he walks away, no matter how exciting the opportunity sounds. In 1999, during the dot-com bubble, Buffett refused to buy any tech stocks. Magazine covers asked if he was past his prime. Investors called him outdated. Tech stocks were doubling every month, and Buffett was sitting on the sidelines. Why? Because he couldn't answer question one. I don't understand how these businesses make money. Without thorough analysis, it's speculation. And Buffett doesn't speculate. When the bubble burst in 2000, and tech stocks lost 78% of their value, but Buffett's portfolio barely flinched. The outdated investor preserved his wealth while the smart speculators were wiped out. That's the power of knowing the difference between investing and speculating. Let's look at our second story, the intelligent investor versus the clever speculator. Graham says, there are two types of investors. The defensive investor. The investor who wants safety, simplicity, and doesn't want to spend much time on their portfolio. This person buys diversified, high-quality stocks and bonds and holds them. They accept average returns in exchange for peace of mind. The enterprising investor. The investor who is willing to put in significant time and effort to find undervalued opportunities. This person does deep research, hunts for bargains, and aims for above-average returns through superior analysis. Both are valid forms of investing. Both satisfy Graham's three conditions. They're different strategies, but both are grounded in analysis, safety, and reasonable expectations. What neither of them does is gamble. Neither of them buys a stock because it's going up. Neither chases hot tips. Neither expects to double their money overnight. Neither mistakes excitement for analysis. And that's the trap most people fall into. They're neither defensive nor enterprising. They're something Graham never endorsed: the lazy speculator. Someone who does no research but takes aggressive risks. Someone who wants the returns of the enterprising investor with the effort level of the defensive investor. That combination of aggressive risk with zero analysis is the single most common reason people lose money. Not because the market is rigged, not because they're unlucky, because they speculated and called it investing. Let me show you this playing out in the most recent times. Between 2020 and 2023, something happened that would have horrified Benjamin Graham. An entire generation was taught by apps, influencers, and social media that speculation is investing. Robinhood, the trading app, added over 10 million new accounts during the COVID times. In the UK, trading 212 and free trade saw similar explosions. And what were these new investors doing? Let's apply Graham's three-part test. Thorough analysis? No. Most were buying stocks they heard about on Reddit, TikTok, or from friends. A 2021 survey by FINRA, the U.S. Financial Regulatory Authority, found that over 50% of new investors during COVID did no fundamental research before their first trade. None. Safety of principle? No. Many were using leverage products like options, margin trading, leveraged ETFs that could amplify losses beyond their initial investment. Some were using money they couldn't afford to lose, like student loans, credit card cash advances. Adequate return? They weren't looking for adequate. They were looking for 10x, 100x, the language itself to the moon. Diamond hands is the language of speculation, not investment. By Graham's definition, almost none of these people were investing. They were speculating. Every single one. And there's nothing wrong with that, if they knew it. But most of them didn't know it. They genuinely believed they were investing in their future. They called themselves investors. The apps called them investors. The media called them the new retail, investors. And when the market turned in 2022, when meme stocks crashed 70 to 90%, when crypto collapsed, when the speculation bubble burst, then these investors lost real money. Benjamin Graham predicted all of this. He warned that the most dangerous moment in financial markets is when speculation becomes so widespread and so normalized that people forget it's speculation at all. When gambling looks like investing, feels like investing, and is marketed as investing, that's when the most damage is done. Graham acknowledges that the line between investing and speculation isn't always perfectly clear. It's more of a spectrum, so let me help you figure out where you fall on that spectrum. Ask yourself these 5 questions about your most recent financial decision. First, can you explain in 2 sentences why you bought what you bought? Not because it's going up. Why is it going up? What's the business model? How does it make money? If you can't answer that, then you're speculating. Second, would you be comfortable if the market closed for 5 years and you couldn't sell? Would you still feel good about owning what you own? An investor says yes. A speculator panics at the thought. Third, did you determine a fair value before you bought? Do you know what the thing is actually worth? An investor buys when price is below value. A speculator buys when price is going up. Fourth, what percentage of your investable money is in this position? If it's a small percentage, then maybe you're taking a calculated risk. If it's everything you have, then you're gambling. Fifth, are you checking the price multiple times a day? An investor checks quarterly. A speculator checks every 10 minutes. If your heart rate changes when you open your brokerage app, then you're speculating. Be brutally honest with yourself. There's no shame in being a speculator. As long as you know you're speculating, you use money you can afford to lose, and you don't confuse it with a long-term investment strategy. The shame is in fooling yourself. When I first read this chapter, I felt exposed because I realized that most of what I had been doing with my money wasn't investing. It was speculation with a nice label. I was buying stocks I'd heard about on podcasts. I hadn't read a single annual report. I didn't know the PE ratio. I didn't know the debt levels. I didn't know the competitive landscape. I just knew the stock was popular and going up. That's not thorough analysis. That's not safety of principle. That's not investing. That's speculation. And I was doing it with money I genuinely needed for my future. After reading this chapter, I did something uncomfortable but necessary. I went through my entire portfolio and applied Graham's 3-part test to every single holding. Thorough analysis, Safety of principal? Adequate return? About 60% of my portfolio failed the test. 60%. These were positions I had taken based on hype. I sold most of them over the following months, some at a loss, and I replaced them with boring, researched, fundamentally sound investments. Index funds, blue chip companies I actually understood, positions where I could explain my thesis in 2 sentences. My portfolio got a lot less exciting and a lot more profitable. Because excitement, it turns out, is a symptom of speculation. Confidence is a symptom of investment. There are 3 takeaways from this chapter. First, apply Graham's 3-part test to every financial decision. Before you buy anything like stock, crypto, real estate, ask, have I done thorough analysis? Is my principal reasonably safe? Am I expecting an adequate and not spectacular return? If any answer is no, you're speculating. Never speculate with money you can't afford to lose. Second, separate your investing money from your speculation money. Graham's practical advice is to keep speculation to no more than 10% of your total portfolio. Put it in a separate account. The other 90%, that's your investment portfolio. Manage with discipline, analysis, and patience. Never let the 2 accounts mix. Third, ignore the crowd. When everyone around you is making easy money, when your Uber driver is giving stock tips, when your barber is talking about crypto, when every headline says this time is different, then that is precisely when speculation has been disguised as investment on the largest scale. That is when you need Graham's voice in your head the most. Are you investing? Or are you speculating because everyone else is? That's chapter 1 of The Intelligent Investor, Investment versus Speculation. This chapter draws a line in the sand. On one side, we have disciplined, analytical, and patient investing. On the other side, we have speculation dressed up in a suit. In the next video, we'll cover chapter 2, The Investor and Inflation. Graham explains why the silent, invisible thief called inflation might be stealing your wealth right now, even if your account balance is going up. If this chapter made you rethink how you handle your money, hit that like button, subscribe, and drop a comment. And be honest that after hearing Graham's 3-part test, are you an investor or a speculator? I'll see you in the next one.